Hello, folks online, if you can see me. Hello, folks in the room. Thank you so much. I know for some of you who had to hear from me twice in one day, it's a lot, I apologize, but I'm Miriam Freeman. I manage our financial health portfolio at JPMorgan Chase. And as part of that, have the pleasure of working very closely with the Ideas 42 team. So I want to thank them for bringing together all of these great folks. I also want to thank and congratulate all of the cohort members who you'll be hearing from today, and our advisory group, many of whom are here in person, as well as I don't think I can see them, but I know that there are some folks online as well. So thank you, everyone. I know it's a big ask, especially during a busy week, to be here. I just want to give a couple of opening words on behalf of JPMC to give a little additional context on why we think this work is so important, although I know I don't have to convince any of you about that. And then I will turn it over to the great work for it to speak for itself. So JPMorgan really does see the strength of our business and our firm as tied to the communities that we serve. And that's what drives our commitment to inclusive growth. And as one of my colleagues said earlier today, we are located in 48 states and growing. And so having that local presence and the connectivity between our community involvement and impact and our business impact is more important than ever. And as part of that, we also know that it's important to have a mix of stakeholders who can tackle the complex challenges. And we can't do it alone. We can't do it as just a business. We can't do it without our other financial institution partners, without other fintech partners, without nonprofit partners who work closely with communities. And so this is really an opportunity to bring together all of those pieces of the puzzle and foster collaboration. And so it's really wonderful to be able to facilitate those connections as well. And in particular, with credit and credit building, we know that credit is something that underpins all of that connectivity. So it's a foundation for folks, not just when they're managing their day-to-day cash flows, but also as they're thinking about other pieces of their financial lives and their well-being writ large. So I mentioned this earlier today, but the connections, for example, to homeownership, to small business, which are built into this work, it's intentionally scaled over 3 years to be able to bring out some of those pieces of connectivity. I just want to highlight a couple ways that all of these things come together. For those in the room, there is a handout that has some examples of some of the work both across our business as well as our philanthropic portfolio. And for those online, this will be posted and available later as well. There's also around the room some examples of the credit landscape that the Ideas 42 team has put together. And this really is an invitation for this to be a conversation. It's sort of the first pass, but we know that our work together is going to bring out many more examples and ways to build on this work and understand what works together too. So in terms of some of the business impacts, today Project Reach was mentioned. It's an OCC initiative that also involves many of the same stakeholders who are in this room. And it's had incredible success in terms of being able to bring folks who have not had access to credit into the credit system. And through that initiative, we've been able to qualify 50,000 and growing folks to newly qualify for credit. Similarly, we have a tool that's available online for everyone. It's called Credit Journey, and we've been able to build on that as well so that folks can build in their financial goals as they relate to their credit objectives. And it really has made a difference. People have improved their credit by 30 points when they complete a plan, which is a great stepping stone to affordable access to credit. And that's tied to why we're doing this work here. The access side and bringing folks in who've been excluded from the system is such an important part of the puzzle. But we also know that there's more to do, in particular for folks who may have a credit score, but it's not a high enough credit score for them to be able to participate fully in the financial system. And that's where all of you come in. We're really excited about the partnership with our philanthropic dollars to be able to see the types of innovations that we hope can then be scaled by ourselves, by others, by the industry. It really is a group effort, and we really appreciate all of you in doing that work. So with that, I just want to tease our keynote speakers who are coming up next. We have Alex, who's going to be speaking about some of the landscaping, which, as I alluded to, you have some papers that you can look at in terms of where those gaps continue to exist in the ecosystem. And I would be remiss in the Ideas 42 context if I didn't mention the role of behavioral science, which Piyush will talk about. And really talking about not just the impact for individual consumers changing their individual behavior, but re-engineering the system so that the system is designed to set consumers up for success. So I'm really excited about both of those pieces. I'm really excited to hear from all of the cohort members here today. And I just want to thank you all again so much for your participation. Thank you. Over to you, Al.
Thank you, Miriam. I'm Piyush Tanti. I'm Chief Innovation Officer at Ideas 42. I was the founding executive director, and before that, I was a consultant at Oliver Wyman and did a bunch of work in financial services, actually, and a bunch in consumer credit, including back in the day at project managing the process of building the Vantage score with the 3 credit bureaus. So it's kind of fun to come back to this topic. But before I jump in, anybody who signed up on Eventbrite or the folks online, did you see a little hidden disclosure in the instructions that you received? It was a nice favor that the team did for me, where they asked people to shave their heads. There. But if they wanted to opt out, they would have to let us know. And I think no one let us know. So I'm hoping, I don't see any shaved heads here, but I'm hoping online is at least one person, with me here. So why did we do the disclosure? And why is it so easy to miss these things? Like, part of it is just our attention is supreme. We have lots and lots of research showing that we can focus on 1 or 2 things at a time. The other part of it is that all of you are probably suffering from scarcity of time. And that means that you're constantly juggling a lot of obligations. You're having to make trade-off decisions. Do I do this task first or that first? Do I sign up for that conference or not? Do I travel here or not? And that takes a lot of toll on our brains. It taxes our brains enough that it's like losing a night of sleep. Right? So that causes us to focus on kind of tunnel on immediate priorities, and therefore be less able to plan for the future. Right? So this is hopefully starting to give you a clue for what might be happening to the people we're trying to serve. Right? Why they don't engage with us, maybe why they don't take up some of the products and services that could help. And so I wanted to use this as one example, psychology of scarcity, just to illustrate how behavioral science can help us understand the people we're designing for more deeply, but then also point us to solutions and how we might design products, services, the system, differently. Right. So scarcity, the research study that started all of this was done in a mall in Jersey. So the researchers just find subjects and they give them 4 scenarios of some kind of financial emergency coming up. Right? And some people get easy scenarios, some people get hard ones. And easy scenarios, cars broke down, it'll cost you $150 to fix it. Where are you going to get the money? The hard one, same thing, car broke down, but now they need $1,500 to fix it. They also ask people what their income is. And then while they're thinking about the scenarios, they take a couple of tests of cognitive capacity. These are sort of like IQ tests. And what they find is that the people who are below median income, they do worse on those IQ tests when they're given a hard scenario. But when they have the easy scenario, the $150 emergency, they do just as well as everyone else. Other lower income folks as well as the higher income folks. And that drop in performance is equivalent to losing a night of sleep. It's that costly. Right? So if you're suffering from scarcity, this is what's happening to you. Now, to start to solve for this, we need to get deeper into what causes scarcity. So of course, it's scarcity itself. I have too little of something, time, money, but it's also volatility. So if I have volatility of cash flows, that is what requires these constant trade-offs. Like 1 month I'm flush, the next month I'm on a downturn. I got to figure something out. So how do we solve this? Well, obvious answers. Well, if you just give people more money, yes. If they had more money, sure, we could solve it. But barring that, what also helps is giving people a cushion, some way of cushioning those downturns. So that could be credit, that could be savings. Right? So great, all these products therefore should be helpful. It could be insurance. But then how do we get people to attend to these products? How do we get people to actually engage with these things if they're stuck tunneling on immediate priorities? And this is where a second study about scarcity really helps. So it turns out that scarcity is not constant. Right? So this study was done with sugarcane farmers in India, where sugarcane harvests happen once a year. And just before the harvest, the farmers are very low on cash. And just after harvest, they get all of their income for the whole year. So they have a lot of liquidity. And these harvests are staggered. So you don't have seasonality effects. You can study farmers before and after the harvest in a pretty unbiased, clean way. And it turns out that they do poorly on these cognitive tests just before the harvest, and then they do well on them right after the harvest. Right, so that starts to give us clues, right? What if we could find moments of liquidity in people's lives? Like, are they more able to plan for the future right after a paycheck or just before the big payment is due when they have the cash? Could we even create moments of liquidity? So when they receive credit and that credit is funded, is that moment, a moment of liquidity where they're feeling a bit of relief from scarcity and they'll be more likely to take up other things? So this is just one example of a psychology that matters for the people that we're serving. And hopefully this gave you a little bit of a taste of how we use the science to think about design and apply it to solving some of these problems for folks. There are many other psychologies. This research goes back to the 50s. Most of it is sitting on the shelves in journal articles. Academics read it. Not that many people use it. Marketers use some of it. UX designers use some of it. But there's a lot that we can use. So there's a wealth of research that can really help us. So I will stop there and turn it over to Alex, the next speaker.
Well, two things you mentioned that resonated with me. One is scarcity of time. I have 3 young children at home, and so I have no time whatsoever, which has impacted my cognitive performance significantly, I can say. So if I forget any proper nouns or just stumble up here, please forgive me. Second, if things continue to go the way they're going up here, I will be embracing the bald-headed option sooner rather than later. So I probably did check the box for that one. I am here because I write a newsletter called Fintech Takes. And in that newsletter, I rant constantly about credit building. It is my true passion. It'll probably be on my tombstone when I die. I care deeply about credit building. I'm obsessed with it, probably to an unhealthy level. And the reason that I'm so obsessed with it, more than anything, is credit building and access to credit are incredibly important. Before I started writing the newsletter, I worked at FICO and got to see how the credit system works up close. And there are a lot of parts of it that are deeply unintuitive. In fact, early in my career, I taught credit education in a bunch of local high schools and middle schools in my community. And until you've stood in front of a bored 15-year-old trying to explain how the credit system works, I don't ever want to hear like, oh, credit, education or financial literacy is the answer. By itself, it's really hard to get people to understand how these things work. And so, when I started evaluating credit building products as a category, and I think I've looked at pretty much every credit builder product that exists on earth at this point, one of the things I was struck by when I would talk to companies is they would always say, this is like the #1 product or feature that our customers ask us for. Time and again, it's always #1 on our list. We have to build something to solve this problem because, again, access to our credit system is not an obvious thing. There is no obvious, easy on-ramp to get there. You have to have credit before you can get credit. It's this very strange catch-22. So everyone wants to build a solution to help fix that. The challenge is there are a lot of different ways to solve that problem, and not all of those ways are built equally, right? And so while I don't want to discourage innovation around credit building, in fact, quite the opposite. I love harnessing all of the collective creativity that exists in financial services and fintech to try to find new ways to address this problem. And we've come up with some great ways. I do think it is worth thinking a little bit about what the North Star is that we should be building towards. And regardless of how we get there, we should have a common set of principles for the way in which we build and why certain things are important. So I want to articulate what I think some of those might be, but again, this is all very sort of early draft. The first principle that I think is really important with credit building is that anything we do needs to make it easier for lenders to accurately price risk. And I know, especially for a group like this, sort of standing up and saying, I think we should work for lenders to make their lives easier. That's not like a pitch that's going to work really well with this audience. But the reason I say that is there are a lot of different ways I can make your credit score go up. But if I make your credit score go up in a way that doesn't accurately reflect a change in your behavior and thus your risk profile to lenders, what is going to happen, and in fact, what is happening today with certain categories of credit builder products is you're going to go into a lender and you're going to say, I have a 680 FICO score or 680 Vantage score, and I'm going to apply and I'm pretty sure I'm going to get approved. And then you're going to get declined and you're not going to know what happened. And what actually happened behind the scenes is lenders, who again, their job is to accurately price risk so that they know what risk they're taking, they are screening out your credit builder trade line because they know that the design of that specific product is not an accurate reflection of your behavior. And because it's not an accurate reflection, they can't trust it. Thus, in their own custom underwriting model, they screen that variable out. Or in some worst cases, they actually penalize you for having that variable in there. That's bad. That takes us away from what we're trying to do. So I think the first principle needs to be everything we do in credit building needs to help lenders more accurately price credit risk. And lenders need a lot of help with this, by the way. There are a lot of lenders that don't do as good a job as they could in accurately understanding and pricing the risk of different borrowers. So we need to help them get better at that. The second thing is credit building should never be embarrassing or confusing. And the critique I have of traditional credit builder products, and we'll just pick on like secured credit cards as an example, is not that secured credit cards as a product are horrible. There are some downsides. You have to have enough as a deposit to put aside. That challenges cash flow and liquidity. There are problems with the product category, but it does work reasonably well and it helps lenders manage their risk. The problem with credit builder cards and the sort of traditional secured card is that you felt like a loser when you were applying for one, right? You'd go to the website, you'd look at all the cool cards that they had, and then at the very bottom, there was a secured credit card. And they didn't quite say this explicitly, but it was pretty easy for consumers to read between the lines and see what the lender was saying, which is only losers use this card, right? That's bad. That's embarrassing. And I think one of the biggest things that fintech companies have done to improve credit building is they've said, it's okay that you don't understand this. This doesn't make sense to anyone when they get started. There is no 17-year-old that intuitively groks, oh, this is how the credit system works. It is okay for you to not understand this. We're going to help you. We're going to help you navigate this challenge and build credit. That messaging and that framing is incredibly important for young consumers, for recent immigrants, for people who have experienced some kind of challenge to their credit that has harmed their credit score and they need to build back up. It's okay to tell people this is hard, this is not intuitive, but we're here to help. That's really valuable. At the same time, though, and this relates to the first point about accurately pricing risk, credit building should never be something that is quick or easy. And I wish it could be. I wish there was some magic button that we could push. But the problem with a lot of credit builder products is they say, not only will we help your score go up, but we will help your score go up in a month or 3 months. And the reality is changing the trajectory of a consumer's financial behaviors, which again is what's the input into lenders' underwriting models, that takes time, right? We are changing the trajectory of how people use different products and how they manage their obligations. That is a very valuable exercise, but it's not something that can be done in 3 months. And so the speed and the ease with which we are pitching these products, it needs to be realistic about what it actually takes to change someone's creditworthiness. And that's a really important factor. And then the last one, and I think this is just bears repeating, is credit building shouldn't be a monetization opportunity. And the reason I feel this way is because, and I think this is aligned generally with the way regulators and policymakers look at this topic, access to the credit system is a right? It's not a privilege of those who can afford it. And while credit building, I think, is a very lucrative opportunity for fintechs, for banks to be involved in, because you can cultivate new customer relationships. You can use it as a wedge to acquire customers. You can use it as a wedge to retain customers. You can use it as a way to learn more about your customers in a digital first environment where people aren't coming into the branch. It's not a good thing to monetize directly. And I do have the sense, talking to different regulators and policymakers, that they are paying attention to this area. And there are going to be more rules and restrictions around how these products need to work. And I think one of the best things to do if you're building one of these products is to think about how credit building can be a part of a larger suite of products that you offer to customers, not an individual product that you try to maximize your profitability around. So with those three sort of pillars around credit building, I think we can start to aim in a direction where all the credit building products offered by fintech companies and banks and nonprofits that are all trying to help solve this core problem that we all see, they can all slowly evolve and get better over time. And that's why I'm so excited to be participating in today's event. So thank you.
Good afternoon, everybody. Welcome folks in the room. Welcome people on the webinar. I'm Evelyn Stark. I lead the financial help team here at Ideas 42. And today I am joined by our inaugural cohort of partners. So Piyush jumped into shaving his head, but let me also just tell you a little bit about what Ideas 42 does. We are a nonprofit behavioral design firm. We generate impact across a range of issues, not just financial health. And our goals are to build better systems, policies that drive social change. On the financial health team in particular, what that looks like is focusing on things that reduce distress for customers. And we do that for two reasons. One, to reduce distress, to relieve scarcity. And the other is to set people up for success, to leverage the opportunities that the financial system does enable. And I think you heard that from Miriam earlier. We're talking to this cohort, which is a part of a three-year project called Credit Expanding Opportunity, CEO. It is supported by JPMC. And I am saying supported because they are supporting us with funding, but they're also supporting us with thought leadership. Their advisory group members, we have several members from JPMC, and because they are one of the largest banks, if not the largest, I'm sorry, I think it's the largest. And so we're going to be working with them to design for scarcity and stigma that we've just heard about, and so that people who interact with our products, our websites, are able to do so, get the information they need, take the action that they wanted to take when they started. One of the things that I think you already heard, but let me just emphasize, is we are not here to try and change individual behavior. It would be a losing game to try and change every individual's one by one. What we're trying to do is change the context in which individuals make decisions so that the decisions they make are the ones that they wanted to make, the ones that are going to move their families forward and allow them to reach their goals. So if you hear us talk about context, that's what we're talking about. So am I supposed to stop what I'm doing and allow you to run a video? Yes. There we go.
At SaverLife, we believe everyone should have the opportunity to improve their financial health, which is why we launched the first ever financial health platform designed specifically for people living on low to moderate incomes, making the journey to financial health more accessible and inclusive. And because we know credit is fundamental to our growing membership of nearly 700,000 consumers and the millions like them, we use our platform to test interventions like referring members to credit building opportunities. This project gives us an opportunity to learn how and when our members can most benefit from credit building opportunities. With these insights, we can inform the larger field and optimize future solutions, increase their uptake, and improve financial outcomes.
My name is Michelle Jones, and I'm the Chief External Affairs Officer at Money Management International. MMI is a national nonprofit provider of one-on-one financial counseling, education, and debt repayment services that help consumers reduce debt, rebuild credit, maintain housing, and improve overall financial well-being. Our purpose is to make life affordable for all. To do that, we invest in technology that allows us to meet people where they are. We modify our services to meet emerging needs, and we remain laser-focused on data, which allows us to identify trends, measure impact, and contribute to the national dialogue about consumer financial health. One of our biggest challenges is motivating people to take the final steps to enroll in a debt repayment plan, which, if used, has tremendous upside in terms of debt reduction, credit score improvement, and highly impactful cost savings. We're so pleased to partner with Ideas 42, SaverLife, and JPMorgan Chase on work designed to address this critical challenge. On behalf of all of us at MMI, we thank you for the opportunity.
My name is Brett Billick, and I'm the CMO of Self Financial. Self is a credit building platform with multiple products to support consumers with low or no credit. We have over 1 million builders. Ultimately, out of all of our products, the goal is to make your payments on time and put positive news on your credit report. So that's the biggest challenge we are facing. The ability for our consumers to meet their payment obligations over time in the midst of all the things that are happening in their lives. How do they view the credit bill or loan? Where are they making trade-offs? And how can we help set them up for more success right when they sign up? Putting more positive news on your credit is the goal. We're super excited about this project and working with the Ideas 42 team and the advisory group, and we look forward to having more impact in the future of our customers and communities' financial lives.
Hi, my name is Ryan Deitch and I'm the CEO of Arro. We have built a new kind of credit building platform where we can help underserved consumers get access to and build their credit in a way that directly aligns behavior with a financial service. We issue a credit card that starts as low as $50. As members make payments, set goals, and complete educational lessons, we gamify it so that customers can grow their credit lines by exhibiting the appropriate behaviors. We can actually shape someone's risk and set them up on a different path by engaging in our program. And we're partnering with Ideas 42 to help us map out these behaviors and set up a better path for our customers.
Hi, I'm Erin Allard, president of PrismData. Prism analyzes consumers' deposit account transaction history to help lenders go beyond traditional credit data in considering a consumer's creditworthiness. This allows lenders to confidently serve the 36 million thin and no-file consumers in the U.S. with products like Prism's Cash Score. Cash Score is an off-the-shelf risk score based only on cash flow that, when lenders incorporate, allows them to make better risk decisions, serve more consumers, and build credit access. That's a win for everyone.
Okay, excellent. So I am going to ask some questions. That's how webinars work. But I also want my fellow panelists to actually ask questions as well. So this is not a debate. We're not trying to do any gotchas, but if you have a question that legitimately would work, go for it. And I'm going to start with easy questions first. And especially since we didn't have the video, feel free to take another little bit of time, folks. I'm going to ask you to introduce yourself. Give me a brief overview of the product you're working on and how it helps people improve credit scores. I'm going to go from that side over this way. Amy.
Hi, I'm Amy Linz. I'm Vice President of Customer Success at Money Management International. For those of you who aren't familiar with MMI and the work we do, we are a national nonprofit in the financial counseling and education space. We have products like credit counseling and debt management, housing counseling, financial education in the community. And the product and service that we chose for this program is our credit counseling and debt management plan products. And why did we choose that as a focus on a credit score improvement project? And the reason is because credit counseling and debt management, actually rebuilding credit, is a credit improvement activity. And a lot of people don't make that connection, but our average client experiences an 84-point credit score increase when they go through our program. And so we're really excited about being a part of this cohort, but our products, and particularly working with SaverLife as our referral partner, are not without some challenges. And some of those include the debt stigma, the uptake on taking action for a referral, and also on moving into solutioning and moving forward with credit repayment through a debt management plan for those who have that as a recommended solution. So we're focusing on that referral improvement and then on the taking action for your solution as our two pieces as we work with SaverLife.
Go ahead, Sarah. Great. Sarah Willis, Air Tour. Lots of friendly faces in the room. Don't have to imagine the audience got their clothes on. I am the
being recorded.
Oh yes. I thought we were muted. Anyway, I I am the Executive Vice President at SaverLife, and I look after a number of things, but really thinking about the organization's growth, sustainability, and how we're leaning into innovation. For this particular project, you would have heard from my colleague Cameron, maybe that'll still happen. She built a really awesome video, so it's too bad. But SaverLife, for those of you who are unaware, is a tech platform that we've built that is really exclusively designed for low to moderate income consumers. We bring it together for about 700,000 consumers and really millions like them in the US. And it's a combination of rewards, incentives to really get people to build that savings behavior and habit, and much more, content and referral partnerships, which is where Amy was going. We actually have referral relationships with several folks in the audience as well, self included. So one of the things that we are sitting on is an incredible amount of data about our members, both self-reported, transactional, in-app behavior. It's, you know, no shortage of data. Don't always have enough time to dig into it, but no surprise, credit is an essential part of our members' lives, and it is really their pathway to economic opportunity, hence the name of your project. And the basis for this engagement, as Amy was saying, was really how can we, knowing what we know about our members, 54% of them have unmanageable debt. So that, and largely, if you look at the credit scores across the US, I think 48% of SaverLife members are below prime, so near prime or subprime. So representative of the US writ large, how do we actually make sure that they're taking the steps, moving from, you know, intention to action, as the behavioralists like to say, to get into those right services that meet their needs at any given time. I'll save it.
Question.
Yes,
Excellent.
thank you, everyone.
Erin.
Sure. Hi, everyone. Erin Allard, President of PrismData. We have a little bit of a different role here than my counterparts. So we're the data partner, I think is the right term. So Prism kind of sits behind the scenes a little bit. We are a scoring and analytics provider, helping banks, lenders, anyone who's trying to really look at consumer risk, whether it's credit or in other capacities, do so using bank account transaction data. So we have an API platform that sits on top, similar to you, of a substantial amount of data kind of up and down the consumer credit spectrum. And we work with lenders to, first of all, look at thin file and no file individuals who they can't accurately score today. Also looking at folks who have a subprime score, looking at what's their actual risk right now. How do you price that risk? How do you think about who is a good bet and who you may not be able to lend to at this time? So we're excited to work with the folks here and see how we can help everyone continue.
And then let's move over to the fintech folks and Arro.
Thank you. Hello, my name is Ryan Deitch. I'm the CEO and founder of Arro. And we've built a new kind of credit building platform where we can essentially help anyone get access to a fully unsecured revolving credit card. We use a mix of cash flow and credit data as well to underwrite consumers. And we start people off as low as $50. So we're the smallest unsecured card to ever launch into the market. We also don't conduct a hard inquiry upon application. We are also the only unsecured card that gets to do that because, one, we start small, but what happens after touches a lot of the concepts that a lot of us are here for. Once you get approved, the first thing we ask you to do is set a financial goal. If you do that, we increase your credit line. And we've basically built a gamified experience that says we want to train you on how to use credit responsibly. You know, something Evelyn said is, how do you attack, you know, this problem at an individualized level? Our approach is to try to scale an individualized level using gamification and technology. So we have built a financial literacy program in-house that trains you on everything from how to avoid interest, how to spend credit responsibly, how to budget, how to save. As you take educational lessons, we increase your credit line. To keep moving forward and to keep growing, you do have to make payments. So we try to segment the different patterns and areas around responsible lending, responsible behavior directly with credit access while helping people build their credit alongside the way. And so excited to be here. One of our goals of working with Ideas 42 and in general of why we're so honored to be part of this cohort is changing behavior, as we all know, is so difficult. And having partners with true behavioral science expertise, thinking about not just payments and repayments, but all the other factors that associate with that. You know, there are a lot of symptoms of this problem, but financial literacy doesn't solve it. behavioral science doesn't solve it alone. But when you find ways to wrap these together with a product, with an opportunity that people really get behind, there are ways to crack the code that a lot of people are not working on right now. So I can continue to rant, but I will pass it along and
Give you more time.
look forward to sharing more as we go along.
Brett?
Hi, everyone. My name is Brett Billick, and I'm the CMO of Self Financial, originally known as Self Lender. We are probably really one of the first credit building platforms to go to market years ago. And we have evolved, but I think the main thing is you heard as well as what Alex was talking earlier. Our mission is around helping people build positive change and positive behavior, and our products reflect that. So we have credit builder loan product, we have a small dollar secured credit card, we have a very small unsecured credit card. We've evolved to add more reporting through rent reporting, utility reporting. And ultimately, our goal is and our mission is to give people a way to access credit, a way to build credit over time, and can really be an on-ramp for them for their future goals and represent something that's really important, which is being able to financially cope and be able to deal with things that happen in their lives and shocks to the system that they experience. One aspect of our credit building loan product is savings. That is a really important piece of what we do. We'll talk about more later kind of the dynamics, but one of the reasons why we are excited to be part of this project and I've been trying to work with the Ideas 42 team for years, and I'm really excited to get to do it now and have our team be able to learn the principles that they bring to bear is really ultimately about helping people make their payments, making their payments on time and fulfilling the duties and the obligation to themselves first, and then to lenders second, show the rest of the world that they're good for it. So a lot of what we're focusing on truly is around kind of how people can get through that, specifically with a lot of the context and the things that are going on in their lives, like scarcity, as you mentioned, that can really be disruptive.
Great, thank you. I'm so happy to have all of you here. I am going to try, you guys are already getting ahead of me, so I'm going to try and play with my little note cards here. But Sarah, I'm going to ask you and Amy a couple of questions together, but I'm going to start with you. People are focused on this referral process. How do you know which customers to refer to Amy, to MMI, to DMPs, debt management plans? And how are you focusing your work on getting those referrals towards the take action side?
Well, we're getting ahead of you because you did such good prep.
There you go.
So as I was saying earlier, we have a number of ways that we can identify or detect that our members perhaps may benefit from one of the many services that MMI may offer, whether it's credit, card consolidation, debt management plans, or straight up credit counseling, which is also effective. And so what we are doing, and really an essential cornerstone of where SaverLife is going, is to really think about that personalization based on data, and not just data that we get when they walk in the door and we do financial health survey, which is important, but really is that point in time, but really combining those goals and that intentionality that a member may have, monitoring that over time, comparing that to their transactional data. So if we see that a member is paying a recurring payment to a debt collector, we know there's something, maybe to be done there. We see that they've recently missed some payments that they were normally paying. They've been charged overdraft or late fees. That's an indicator to us that we might want to take the opportunity to make them aware of these offerings. So it's really about leveraging that data for the, just in time. I guess that's the combination of financial education and behavioral science, right? Acting and helping someone see an opportunity that they otherwise wouldn't see. But lastly, what we're really excited about in this partnership, in this project, is really going much deeper on the messaging, specific message testing, the timing of the messaging, and then being able to track, since we have a data sharing agreement, how that actually translates to actual outcomes. So it's great to get someone into these programs, but MMI does a great job of actually thinking about increases in credit scores. And the beauty of our partnership is that it's bi-directional. So we also have a feedback loop. If there are people who came to MMI who are, now on solid footing, then they can be referred back to SaverLife to start building their cushions and their savings.
Great. And so Amy, you're receiving referrals from SaverLife. but also from other organizations. And we've dealt, I just read too, we've dealt with credit counseling agencies quite a bit. And there is a lot of scarcity and a lot of stigma that is going on. And starting a DMP is a big step to take. And it can bring up a lot of feelings of guilt and shame and all those. So you noted in your intro that these are really helpful and there's an 84-point increase. So how is this referral partner going to kind of build on that and ramp it up?
Sure, and debt stigma is a real barrier, and as you mentioned, and that's why at MMI for the last several years to maybe almost 3 years, our great marketing and public relations team has really been working on a program we call our peer advocate program. And that program takes people who have been on debt management plans and they agree to speak nationally about debt and debt stigma and overcoming debt. And that has been really great for helping people to destigmatize debt and destigmatize debt management and credit counseling. And we want to build on that because what we're seeing with our partnership with SaverLife is that only what our data is telling us is that a low number of people who have been recommended debt management from this pool of referral clients are actually moving to action on that. 9% compared to 40% of other referral partners or like the general population we deal with. And so we want to dig into that and understand why is that and how can we change that? Because we want to figure out how to reach more SaverLife clients, how to move them to action to solve their debt problems and to move into that credit rebuilding journey, right, with us and with SaverLife. And then we want to apply that learning to other referral partnerships and how can we improve them as well and how can we help more people.
And Sarah, I imagine you want to see those numbers go up too.
Yeah, I mean, it's consistent across the board when we think about our platform and what we call our Saver perks, which is what a member would see when they log in to the app. Referrals that might be relevant based on their unique financial situations. But to varying degrees, they don't always translate to what we know to be the case in terms of their financial lives and what types of actions that could really benefit them and be kind of frankly game changing for their financial lives. So what we'll be looking to do is understand what is the right mix of messaging. There's also this obviously behavioral choice architecture. How much are you giving them at once? Are they overwhelmed by the amount of options that they're given or that they're seeing? I mean, I think everyone's overwhelmed these days by the amount of choice, right? And luckily now we have AI and Google, so it kind of streamlines things for you. Speaking of which, I think the other thing here, which no one said AI yet, I'll be the first, or machine learning in this case. We're really bullish on integrating that, but slowly with care and responsibility, but have some interesting partnerships ongoing with academic institutions as well to ask these same questions.
Amy, I know you're a nonprofit, but it feels to me like there's a business case here.
Yeah.
And I'd love to hear what the business case is for MMI.
Sure. Well, obviously we're mission driven. So helping clients and being able to help more clients is certainly, part of that. And there's sort of a double benefit because, the clients, we want them to be successful and complete their debt management plan and rebuild their credit, grow their credit score and those sorts of things. But that's not really the end goal, right? Like pay down debt is just the means to the end goal, which is I want to buy a house. I want to save for my kids' college. I want to have a nest egg to retire on. I want to do other things. I want to open a business, all of those sorts of things. And so this is the means to the end for the client. And, it's a bottom line benefit for them, but for our partners as well, because we're a nonprofit, we have our funders and our partners. And what do they want to see? Our philanthropic partners, they want to see good stewardship of the dollars that they give us. They want to see outcomes and successes. Some of our partners want to see those credit prepared clients because then they're able to take them that next step. They're able to buy the home. They're able to have loans for a business or to save, build wealth, invest, and so forth. So the business case is there. And for some of our lender partners, they want their debts repaid, right? The monies that they wouldn't otherwise see coming back to them and being repaid. And so, it's that win-win-win, right? We win, And our partners win, and the clients are really the ones who win. And so we want to continue to grow that. We want to continue to have that ripple effect out in the community to be able to reach more people. And it takes technology, it takes innovation, but it certainly takes the people that we are being given referrals and that are coming to us. How do we help more of them? And so that's really where we get our bottom line.
Yeah, thank you. Erin, like you said, you are not customer facing, you're a step back. But can you tell us how you're able to use non-traditional data to connect qualified consumers, including folks with who don't have prime scores, with good products and services? And what data, without going into your proprietary terms, what data predicts willingness and ability to repay?
Yeah, I mean, I would say we think about it as fundamentally not non-traditional, right? So if you think about cash flow, it is, if you ask any consumer, are you going to buy a car? How expensive of a car are you going to buy? You're going to take out this loan. For what it's worth, I think credit scores do a good job of a bunch of things, right? So I think they're very important. But when you go to the consumer, they're not thinking about, well, what's my utilization rate? How long have my trade lines been up? And they're like, can I afford this? Does it fit within how I live my life today? And if it doesn't, are there small enough changes I can make that don't really disturb the way that I live to make this possible? So we have built everything on deposit account transaction data. We have found it to be extraordinarily predictive, such that we don't go to other types of sort of alternative data. We haven't needed to. Statistically speaking, when you look at a consumer who has a credit file and they have deposit account transaction behavior, you have an incredibly complete picture. You understand their historic willingness to pay. You can see mortgages, credit cards, whatever's on the bureau file. You can also see what's happening right now in their lives. Are they employed? Are they making enough to meet their non-discretionary spending obligations? Can they buy groceries? Are they doing sort of all the behaviors that you would expect to see? And do they have some left over for maybe a restaurant, dinner out here or there? So when you have all of the data, it's very, very rich. What we found that's really interesting is if you don't have the credit data, so you have a thin file or no file consumer, the scores that we've built that again sit on top of the deposit account data will predict, as well as some of the leading credit scores, will this consumer pay you back or not? And what's also interesting is it really allows you to shine a light on a very big portion of the US population that doesn't have a credit file. They're thin file, they're no file, they're still creditworthy. So over 40%, roughly 45% that we looked at is across real data from our lending partners over a number of years are good credit bets, but you just have to have the right information. And so for us, it's really the bank account information. You asked a second question and I forget what it was, sorry.
That's what data predicts it. But then
Yeah.
You're making me think of one other thing,
Sure.
which though is how do consumers opt in to share their data?
Yeah, so it really depends, right? So not providing compliance advice. You're really clear on that. We have some partners who are depository institutions. So they're FIs. They have what we call on-us data. They provide checking accounts, savings accounts, but they don't lend to these consumers today. So in many cases, those lenders don't need consumer permission. They have a service provider carve out in their T's and C's for their DDAs. We don't accept PII, so you can send us essentially a flat file and say, here's, typically we do a back test first. So here's 6 months of deposit account data, these consumers we ended up lending to, tell us what you would have predicted. And you can do that on a go forward basis as well for existing depositors. For net new consumers, this is where open banking comes in. We talked about earlier, you are going to have consumer permissioning, right? And that's where it's important to be very clear. Think about where in the underwriting flow you want to position it. Why are you asking for this data? What are you going to do with it? What are you not going to do with it? And why is it important, or why does it help the consumer to provide it to you?
So I'm going to ask you guys each one quick question, and then I'm going to lead you to that question too. So Alex talked about the length of time to build credit. So really just like timing, and this is like 5 words or less. How long does it take for somebody to really see an increase in their credit score for each one of you, or for you to have enough information about them in order to be to feel comfortable that on their credit ability and willingness to repay?
I think it varies for our clients. They come to us, some of them are much more delinquent or have, a lot more debt than others, but and they may see a small dip, right, when they first go on a program, but when they go on the program or they get re-aged or they start making payments, and consistent payments are the biggest piece of your credit score. And so, we usually see that start to improve, say in the first 6 months to 1 year of a debt management plan. And then if they stay on and they're consistently repaying, that's when we start to really see the real rise in the credit score over time. It's not a silver bullet. It's not magic. It doesn't happen overnight, and no one should expect that. But that consistent payment and learning new skills on budgeting and being able to stay consistent is really the biggest factor.
And Sarah, are you right around that time frame, like a year or two more?
Yeah, I mean, I would say if we're talking specifically credit, because of all the technicalities of the system and the look back and the lag and reporting and getting into lenders, yeah, that seems really accurate for us. On some of the other metrics that we're looking at, we can get to outcomes much faster. Actually, when it comes to establishing savings and better liquidity, that's closer to 6 months.
And Aaron, you also had a time frame.
Right. So for us, it's how much deposit account data do you need to understand risk, right? So we typically, we'd love to get a year. We'd love to get more, but love to get a year. We typically get somewhere between 3 and 6 months. We can go a little bit shorter if we need to. We did have a lender that used primarily cash flow that looked at post-approval, how long it took. I think it was about a year out that they saw a really meaningful difference of subprime and maybe near prime going into that prime category. So
Can I just add something to that thought? So I think to what Aaron mentioned, I think that the credit score can do a really good job at predicting certain abilities to pay and repay. But as we look at the LMI communities and a lot of people out there who aren't really sure what financial decisions to make, I think one of the biggest problems with the idea of the credit score is it only looks at what you've done instead of what you're capable of doing.
Right.
And what I love from the nonprofit world and what I love from obviously what Arrow's doing in general is if you try to set a path for someone and see what they're capable of, you can actually shape what decisions they might have made or might not have made, because it's really hard. This stuff isn't taught, it's not intuitive. And a lot of people struggle looking more than 2 to 4 weeks ahead in life. A lot of us in this room are looking 6 months, years, and so forth. But if you're not thinking in that way, how do you make the right decisions that set you up to be successful over time? And something Alex said earlier about kind of risk pricing is really what it comes down to. Our thesis is around real-time underwriting. And so you risk price people on a real-time basis based on an ongoing methodology of what do you do consistently that changes, but it comes back to how do you even know what to do? And can you find ways to kind of balance these? But yeah, I just wanted to add that.
Yeah, and you're right in line of where I wanted you to go. So you're using gamification and incentives to keep people engaged for that time frame so that they can increase their utilization, their knowledge, and their credit scores. So what challenges are you focused on?
Yeah, no, thank you. The real vision of Arrow is that we're really a data company that is trying to assess real-time behavioral data that's really hard to capture and associate that with what someone's real likelihood to potentially pay back is, assuming all of these pieces. We use gamification, we use AI. We have an AI financial coach that the dream is it can eventually nurture you on the educational level, at the decision level, and a handful of others looking at your bank account activity, looking at your credit report, looking at decisions you make. But some of the things we focus on there are some basic payments, right? Can you make payments? Will you make payments consistently? How much will you pay? In order to grow, we require that you pay your full statement balance off over periods of time. So if you're just going to revolve forever, you might not, you maybe shouldn't get to a certain level of a debt line. How do you show you're even willing to do that? Because you have to have the money to do that. Think about that differently and embed and train that. Right now, we're working on lots of micro challenges as well. Can you get your utilization to a certain point? Does it have to be rewarded or can it not be rewarded? Is it all associated with a credit line increase or can it be associated with other personal motivational factors, such as this is how you get a path to homeownership or a path to investment? We're finding right now a lot of our users are really interested in investing. They've never invested before. They've read about it. They've heard about it. Everyone wants the path to homeownership, but back to your point on time, that takes a lot of time to get there. And so we use a lot of micro experiences, a lot of kind of higher level goals that people need to reach. The more you reach your goals, we also take time to grow credit lines. Our goal is to try to get you to $1,000 in 9 months. Eventually, maybe some are quicker, eventually, maybe some are longer. But how do we get you to $2,000 next? Can you afford $2,000? Not everyone should be able to get to certain points. So how do you really individualize that in a certain way? Gamification, incentivizing, and then assessing that over the course of time is one of the keys to do that.
Great, thank you. And so we're talking a lot about people with damage credit. We're talking about unsecured credit, and credit building accounts are a bit different. And so I'm interested in just understanding it a little bit, but also understanding how do you explain that difference to consumers? It's a different type of product. You get your lump sum at the end, not at the beginning. So, and you're the marketing guy. So
Yeah.
how do you do this?
It's not always easy. I'd say maybe a bigger meta point for us is that we call our customers builders. We ask them, what are they building towards? 90% of our customers are renting. They don't own a home. They are struggling, but long-term, they recognize two things. One is they're looking for home ownership. And number two, they understand that they're very credit aware. This country has made it very clear how important credit is for many years. I don't think people don't know that, but they don't know what to do about that. And so one of the things that we combat quite a bit is when you're offering a product that takes time and should take time versus other products sometimes that don't take a lot of time, or maybe say they don't take a lot of time, that's a real dichotomy and a perception that we have to overcome, kind of how we communicate and how we talk about what it is. But I would equate it in some ways, I think, almost towards if you're trying to lose weight. You look at your weight, and if you made progress in a week, you see the number went down a little bit, you feel a little more power behind that, you feel like you can do it. And that's how I think we think about credit score in the process of our flagship product, the credit builder account. Is it takes time to increase that score, but what we're offering is hope because you're doing it right, and we're providing all the mechanisms to help you do it right. And this is as low as $25 a month that you're paying, and you're building savings with. And so seeing that change, but also seeing that you can do it is a really powerful part of it. But it is not easy to explain. Well, it's a CD secured installment loan. You get money at the end, but you make $25 over 1 to 2 years. It's not easy. So I think it's a big balance for us to sort of try to represent what that means for new customers, new people that are on the ecosystem, looking for ways to improve their financial lives. And then when they get on the platform, spending a lot of time, and similar to what Ryan's saying, around providing real tools and educating them around what it takes to get there. And that's where we hear a lot of great feedback from customers is we are not we're not credit counselors. We're not providing a lot of that one-to-one, but we are providing things that are part of the experience that say, this thing would be helpful, do this, or make this on time. This is why it's important. This is why you should think about it. And a lot of people really view that as education, even though it's not your traditional financial literacy education. But it takes a while. It takes time.
And so going back to what we were talking about earlier, it does take time and it is evolving, right? And so what, particularly for the fintechs, because as Alex said, the fintechs have really made some changes into the space, and don't reveal your future R&D stuff, but what is the next credit building products? But this is for both of you. What's going to be next? That's going to be a little bit different. It's going to be partnerships. Is it going to be alt data? What's the difference going to look like?
I'd say I'll start. We have traditional products. So we have credit builder loan, which is traditional installment loan. We have secured cards, an unsecured card. Where we've invested a lot more time and energy in the last year is around rent reporting and utility reporting. So it's in the realm of alternative data. I think the ecosystem within financial services has really started to embrace alternative data. They can speak, she can speak way better than I can to this, but rent reporting is one aspect of that. And where we've evolved is to offer free rent reporting, where we are agnostic of how you're paying. We verify your payments, so you connect via Plaid with us, and then we can verify that's happening. And we want you to be able to get credit for what, for many people, is the largest monthly expense. So I think continuing to go down that route of alternative data in different ways, and offering more ways for people to prove that they can access the system and that they are good for it and they're making their payments on time, is this. It's kind of here now in a way, but it's very it's wide open. I guess it's probably the way to describe it.
Yeah, I agree that I think rent reporting and looking at a handful of other transactional experiences can really help you figure out how to build the credit score that exists. However, I have a slightly different take that when someone lives on the edge and isn't sure what to do, anything can change at a moment's notice. People lose their jobs, big bills, right? We all know the average $600 savings for most of America that can't afford one car mistake. And so my thesis is a little different in that I believe that the idea of credit and credit building needs to change to look at a lot more of not just alternative data, but a different kind of data source itself. I believe that the ways in which that groups like the nonprofits are working, that we're doing, is you have to really change behavior for someone to actually be in a place that can afford credit, that doesn't look at just what that moment in time might be or that next 2 weeks might be. And our hope is to create an alternative score that focuses on someone's propensity or capability to just keep up with nudges, education. You know, we're working with some academic professors that want to publish more educated borrower with real-time underwriting. Actually tells you a lot more to complement FICO. I think we need a lot more out there that says your credit score, your credit report does give you a lot of really valuable information, but we need a lot more about people, and that has to be rooted in behavioral analysis. Rent reporting is a great tactic. Other things are a great tactic. Literacy is a piece of that. But how someone responds to working with credit counselors over the course of time will tell you so much more than a mistake that was made or a bill that was missed. Same with approaches we're taking, an approach SaverLife is taking, and a handful of others out there. And Self as well. How someone's able to continue to make payments over the course of time is a piece of that. How they interact with the other tools directly related to that is extremely invaluable, because is it okay that someone misses a payment once? I believe it is okay. If they miss every payment in default, right, that's the problem. But we live in this mentality where once you've made one or two mistakes, we hold it against you forever. Instead of saying, how do we help you come out of that mistake, set it up to be more successful the next time? And it's okay to make a mistake. And I think that's one of the big problems in the space.
Some of the work that we've been doing, and Amy, you know this obviously, people didn't want their debt to be normalized. They said, this isn't normal. This is too much debt. I don't want this to be normal. I want it to be destigmatized. And I really liked that frame, that it was destigmatized. And another thing that we learned in some of our other research was that people like talking about their money. That, you know, we've been kind of trained that we're not supposed to talk about it. But you know, Michelle Jones at MMI posted something on LinkedIn the other day from Reddit. This woman went down and listed all of her debt and her debt management plan and how she tried to get her husband on it. And there are 58,000 people on this Reddit thread. People started answering her. Your husband should join the DMP with you. And yes, your credit score is going to go down, but it's only a dip. It's going up. And it was amazing to me, like going to Alex's thing, like nobody felt like a loser, right? They felt like a builder. They felt like they were taking their, you know, credit knowledge into hand, I think, and SaverLife and taking control. And SaverLife, I see that in all of your pieces on your clients. So I want to hear a little bit more about your clients, something that, you know, how do you keep that forward momentum? But Erin, you are working to reach your clients through partners. So how does your data help them better work with their customers and give them that positive feel instead of the loser feel?
Yeah, I mean, I think it goes to, you can provide so many signals, right? Down to, you know, or from the very sort of basic approve or decline, to pricing, to customization. What type of product makes sense? You know, how should you market to this person? How should you interact with them? How should you engage? And I think when you, in particular, start with someone who doesn't have a lot of options and you help them feel very positive, like, hey, I see you. I see you. I see that you're doing a really good job, and here's how I can help you today. And you keep, you know, sharing some data with me, and I'll graduate you up throughout. I think it's really emotional. Money is a very emotional subject for people, and sometimes it's very positive, especially if you're coming from a spot where you feel bad about yourself, you feel like you screwed up and you don't have options, and all of a sudden somebody gives you a chance and they're there, and in particular, when you think about like the insights that you can glean from this data that lets you be very personalized, I think that's where we're seeing people really kind of take a step farther. Is a lot of personalization of interaction. to due dates, collection strategies, all those sorts of things where you can really say, here's you and you're different from everybody else, and I can help you in a way that makes sense.
Agree, disagree. If anybody disagrees, I think there's gonna be an issue, but
Time to disagree.
yeah, I mean, I would love to hear any other of your stories about builders, or what are your Arrow customers called? Arrows, arrowheads?
Arrow, I like that, by the way. Arrow members. But to this point, so in starting the company, I think all of us have interviewed so many customers over time. And I interviewed, hundreds and hundreds, thousands at this point. And what I say is, like, these are not interviews for long. These become therapy sessions. People love talking about it. And the same pattern was each time. I don't talk to anyone about this. I don't talk to my parents. I don't talk to my family. I don't talk to my partner. There's this stigma around just being open with it because it is scary and it makes you feel bad when you think about it. It's the same with, I missed a bill, I feel bad about it. Maybe I'll miss the next bill because I don't want to have this as part of my mentality. And people kept saying, why is it that my neighbor is able to get an Amazon package that I can't? Or how come at the grocery store, I'm counting out every penny, but the person in front of me is able to afford it? And the more we can open up conversations and communications around this, the more you start to open up a level of transparency that gets people comfortable. Financial confidence is one of the most important parts, I think, of the problem that is so hard to address. We try to do it in some ways. I think everyone here tries to do it in different ways, but it starts with being comfortable with the situation you're in and trying to take the steps to get forward.
I think there's a real community aspect. It's who you identify with, your local community. You can define it many different ways. And we have found this definitely as over the years, as we've grown, a lot of our growth has become as word of mouth. It's because people are telling their friends about the products, or they're telling family members, or they're talking about the issues they face, which absolutely have stigma. That's totally right. But they're a little more open about it, kind of just like, you may not lay it out like the Reddit example, although we do see a lot of that in FICO forums. But it's just, it's around looking for hope, looking for ways out, looking for ways to improve their lives. And I think that probably applies to a lot of different things and not just financial services, but it's really, these connection pieces and where people are and where they're operating. I think that's where there's a lot of power in partnerships long-term with partnerships you see here, partnerships you see in the ecosystem around financial health, where the efficacy is around those conversations that can happen, that can kind of be not just one-to-one, but sort of many to many. And that's how you ultimately have a real impact in this country, which we've been talking about financial health for 30, 40 years. But the impact is, you can see it in pockets, but are we really making enough progress? I'm not really quite sure. I don't know if it's embraced enough, but I know that a lot of people want it to be, and a lot of communities and people are struggling. They're looking for that. So, as practitioners, we need to figure out better solutions and more innovations and ways to work together to do it.
That I fully agree, and that is a great way to talk about this work. So I'm going to ask, actually, anybody can answer this. Who are we in danger of missing? Who could we skip? We all want to reach these customers. We've all described our personalization efforts, etc. Who are we going to miss or in danger of missing out?
I'll start. And I'm surprised you asked this question because you're very, knowing you, Evelyn, you are not so much about the you're either in or you're out kind of paradigm in financial services and financial health. So I don't really think about it as who are we missing. Of course, there are people falling through the cracks, and we see that every day. But what we're really trying to say, and I think as a collective panel, we've maybe failed to really touch on some of the systematic and like contextual issues that that our members, arrowheads, whatever we call them, are always facing.
Sorry.
No, I love it. I love it.
But really this idea that, we can, of course, refine our individual products, services, and our practices. And that's great, but we are going to continue missing out and providing a design, an architecture for the system that is really over-indexing on those with more slack, higher incomes, more resources, social networks. And so I would add, one of the things that we're really leaning into is producing that research so that it's tying into the policy conversations, because at the end of the day, the tax policy changes next year, how buy now, pay later is reported to the trade lines, how medical debt is treated in credit reporting. All of that is going to have a complete wipeout effect on a lot of the progress if we're not actually actively advocating for some of those changes. So.
Well, I definitely agree with you. And we have a consumer distress dashboard that we do, and we're just seeing like a huge increase in the number of people reaching out for help across all levels. Our low to moderate income, but also young people, especially with student loans coming back into play, all of those things. And that was one of the things we were talking about at lunch. You asked me, like, what are the trends you're seeing? And we're just seeing increased amounts of debt for living, right? Groceries, and it's not luxuries. It's, there's this idea in people's heads about how, it's overspending, or it's, spending on frivolous things. And there's this example in our industry about the $4 latte. No, that's not where the problem is, right? I mean, it's like peanut butter sandwiches for my kids' lunch, right? I mean, if I can't afford that, to get the $4 latte. So that's not what people are spending their money on. We really are seeing an uptick in just necessities and the levels of debt across the spectrum, young, old, et cetera. And so, it's hard to pick out who's being left behind, because right now, it's like everybody, and how do we change that? There's lots of lots of things to dig into there. We're just trying to change our small corner of the world, and that destigmatizing debt is so important. And you were talking about that, like with the Reddit, and people do go online into communities because people are okay talking about their debt if it's anonymously. People are not okay talking about their debt in their support network of friends and family. That leads to isolation, that leads to depression. And we ask questions about stress levels and after our credit counseling, and it's always like, yes, my stress level has decreased just by talking about this. So we have to keep that conversation moving forward. Destigmatizing debt, like through, like we said, our peer advocate program, or we have a podcast now that's in season 3 of people coming to talk about their debt openly and publicly, which is way different than doing it anonymously. So I'm encouraged by that.
I have, okay, I'm gonna ask one more question. I'm gonna coach 3 of you guys. So I was going to only give you 2.5 years, but now I'm gonna give you 5 years. So in 5 years, so 2029, we're sitting here and we're saying, 5 years ago at that meeting, we talked about X, and that's what really helped us make changes. So what is the X that we're talking about today that can really help make changes?
For me to go.
Yeah. Especially if it's going to be positive.
I think the biggest thing is embracing new ways to give people opportunities, embracing new data. I'm really bought into that idea. I think that's a really important notion. Again, as has been said earlier, it's not like you throw away the credit score, not like you throw away those models, but you give people more access, more opportunity to where if they missed one credit card payment 5 years ago, it's not still on their credit score and still hurting them. So I think that's a big part of it. But I also say the pivot on that is ultimately the relationships the customers have and the things that need to be improving are the relationships they have with their banks and their credit unions. And that to me is where the change can happen. And a lot of the rest of the people in the ecosystem can help those changes and be complementary to those changes. But this is where the power is, operating within the community, like I said earlier, embracing those things, and then having 5 million members or 40 million customers or whatever else it might be, and really implementing those changes in really fruitful, positive ways that give people the access, give people the hope, and get them on the path to those long-term goals that everyone has. Of course, being a successful homeowner is very hard, but it's the only way to truly change generational poverty. And the only way to do that is to have a full relationship, I think, with your closest provider. And people are not unbanked right now; they're underbanked.
So I'm hearing systemic issues, systemic response, and I'm gonna let you have the last word, Ryan, because you're working with banks and credit unions. So agree,
Yeah, look, I think what's most important that we've talked about here is everybody kind of, I think, is on the same page that by and large, most consumers are going to do the right thing. Not all the time, and sometimes they just can't, but by and large they will. So it's really up to us as an industry to figure out how do we use the tools and the data that's available to actually provide value-adding services. I think we're in a moment in time where the regulators are very clear. They are expecting, it's not just cash flow, but they're expecting financial services providers to meet consumers where they are, to build products that are safe and sound, that are compliant. And we're actually, I think, in a moment where it's more possible than ever before. It's scary. Like, I remember I built products inside of banks. It is not easy going to a credit risk committee and changing the credit policy. It is not easy onboarding new vendors, but it doesn't have to be easy. It just has to be doable. And it actually is. So I think the more that we have large participants really out there kind of leading the charge, and we have other folks doing the same thing and building products and services that help, it starts to change. It's going to take a long time. I don't know, 5 years where we'll be, but I think we'll be in a better spot.
Yeah, good. There were a lot of head nods there. And Ryan.
Yeah, I mean, I think the three of us are very much on the same page here, and I can actually tie this into the last question of who's left out. I think a lot of the lowest of the low income are really left out, unfortunately, and a lot of the deep subprime, whether when that mistake was made, how it was made, are really left out because it's easier to underwrite someone who's new to credit than it is for someone who's made habitual mistakes over time. And to answer the question, all three of us are talking about the institutionalization of this. And in reality, that's the only way you can truly scale at the levels that our country needs. This is an institutional and a systematic problem. Banks need to get on board. The amount of credit unions I've spoken to with a mission to serve their communities that don't actually do any help for LMI communities is wild. And it's kind of unbelievable. When you look at the government's programs that talk about helping, but then don't actually take steps to take it much further into communities to figure out what to do, I think in the end, I think every bank in the country should have some programs, whether it's similar to what we're doing. I hope we'll embed into every bank in the country at some point, but find some way to figure out how to get people into a path that you can graduate them into services. You have to take risk and show people that there is opportunity for them to build that trust back with you and start taking the steps to get better. We've seen in third world and developing countries, you can lend to someone in poverty and they will pay you back if you do right by them. But a lot of the societal perspective around this is, well, I need to make sure the profits make sense. They need to make sense tomorrow. And people need to figure out how to help themselves. That doesn't work for way too many people out there. And I think until we figure that out at a more institutional level, I think we will continue to see the same patterns and themes happening over time.
Well, people in the room and anybody on the webinar, there have been some definitive statements. There have been some slightly argumentative statements. And I'm going to welcome anybody on the webinar and definitely anybody in the room. And like I said, we can bring up behavioral designers to answer, and we could also ask Alex to join again if you want to ask him something. Oh, questions. And I believe Rachel, yes, from Debbie. Excellent.
My question is around, oftentimes we see. So. Oh, it's just okay. Oh, my bad. So one of the question I have is around how to deal with folks that, to your point, you were saying that are kind of in deep, subprime, where maybe they have collections accounts, and oftentimes, say, credit building loans or other credit building products don't necessarily help them because, if I have a collection account, then, that's not really going to make a dent in that. I've been on the hunt for solutions for our population that can solve this problem. Have you guys seen anything that's worked? How to deal with these, how to deal with some of these like deep collections accounts and what the incentives are there for consumers?
It's a good question. I'd say we have a decent amount of experience with deep subprime. And you tend to see with a credit builder loan product, the lower you start, the better it is, because the more incremental it is on your credit report. When there's derogatory marks and other things that have happened, we've also found situations where we have removed, like years past, for example, someone that had a forcible closure in the previous 6 months, we removed that constraint to allow them to start building payment history. So it's not perfect. I'm not saying it answers a lot of those things. I still think it's at some level, even when there are negatives and derogatories and issues that are happening, you need to give them a chance to sort of prove that they can kind of do it themselves as you work through the other issues, right? It's never a clean line in a lot of cases. So we have seen that in some ways from a subprime perspective, but ultimately there's, a lot of programs, counseling services at scale are the answer, which they can do it on a one-to-one basis, but I think at a scale it's very hard to do. And that's the direction I would go for that.
Yeah, I'd agree. With too much collections, you really have to start with debt consolidation and repair and show that there's a path that you're willing to take and embark upon. I wish we could approve everyone, but if you have too much debt and too many derogatory remarks, let's say, like, is our program even right for you? Because how do you ever get that settled and figured out? It will always kind of hurt you in some capacity. That's where
And
programs.
we're the precursor, right?
And exactly,
Like,
and that's exactly.
we help them pass them back.
Yeah, and there needs to be more synergy between, they need to start with someone like you, then they can go to someone like us or Self at some point and figure out what's next. But I don't think there's enough end-to-end paths where people really understand that it's not just one step. People want a silver bullet, right? Human nature.
Well, and there's a lot of predatory people out there who are willing to offer them a silver bullet for a price, right?
Exactly.
Or like they'll start with something like you're thinking it's going to have that impact, or maybe they'll lose confidence or feel like, oh, there's nothing out there for me, but there is. They don't know which solution is right for their population.
Yeah, exactly. And I think you need to start at the nonprofit level and at the local credit counseling level for people like that. And then people like us need to have partnerships with groups like yours that say there are people actually trying to do right. Because what we heard earlier and what we see is the second you get a little better, everyone bombards you. And the predatory lenders are the first ones to figure out, you're probably going to sign up next because now I think I can make my $80 late fee, whatever it is that they figure out. The cash advances are a whole different beast, but like, who's going to really help walk you through step by step? Self is doing an amazing job like us at trying to use technology to scale that. But a lot of the times you need a human to talk through these things with, because you can't just figure everything out. Maybe my AI dream of a financial coach will end up getting there, but we're not close to that level of AI engagement where it's like a person, and it will take time. But I do think that AI will continue to evolve in a level that can actually shape behavior in a way that it doesn't do now, that can help answer questions in lieu of someone, help you make decisions, and do it while evaluating every single data point about a person at a moment in time. And when we get to those stages, I think there'll be a lot more opportunities for people out there.
Okay, so the question is for anyone on the panel, and it says, what recommendations do you guys have to encourage those open conversations with members? What strategies have worked for you to make members feel safe and secured and heard, I guess, when it comes to their financial challenges?
Especially if you're a lender, I'd imagine it's even harder, to be honest with you.
I'm happy to tackle that first. So as part of our educational lessons, we survey people like crazy. We try to get to know you in the beginning. What do you think? Where do you go? Back to financial confidence. How do you track changes over time? And so we try to understand what mistakes you've made, how you've made mistakes, what you think when you're late. Our AI coach shows up to say, why are you late? Is everything okay? How can we help understand so that we can help you avoid this in the future? And we see a lot of responses. A lot of very interesting responses. And we've done some customer studies where people are like, well, I was hoping someone would actually reach out to me to talk about this further. We do not have the resources to do that just yet. Partnerships with other groups could be amazing to do that. But I think people do want to talk about things a lot more than they are, but how you create a safe environment that they feel comfortable, respected, they don't feel bad about themselves. Because a lot of the time when you talk about this, you feel bad about yourself. And I don't know, we try to do it by creating a transparent brand experience that says, we're going to educate you how to avoid interest, how to do the things that no one else wants. We're going to survey, we're going to try to understand, but it's still really hard. And I would love any great ideas that we can help take into to figure out how do you go more and more steps.
Right. Well, people expect to be judged when they come for help. I mean, they're not coming like, yay, I'm going to credit counseling, right? They definitely feel all of those emotions. And I mean, honestly, it goes back to the basics. been over our training department for a long time. That's part of my responsibility. And we work so hard at empathy, like true empathy, not sympathy, and not, having sort of the words you use and the choices that you make in talking with people can really impact how they're receiving your message. And so we do get feedback, and we do a lot of surveys too. And the number of people who say like, wow, I really thought I was going to be judged, and your person was so non-judgmental. They just wanted to help. So, it goes obviously to hiring and training people the right way, but it's really just back to basics. There isn't a substitute for that human connection that people are looking for.
And I'll just add, oh, Lois has a question too, then just add, fortunately, we actually don't have much of a problem getting people to talk to us. We're already very trusted. Everything that we provide to our members has been vetted by financial coach or counselor. We're not selling anything. We're not a lender. We don't hold deposits. So there's this like very safe space about the platform and the community that's already exists, and people who are facing the same types of challenges. But we also just, our standard is we compensate people for their time, and they're participating in our survey or our member panel. And we find that, money does motivate. People's financial lives are so, their margins are so thin that sometimes that quick cash just to get them through to the next pay cycle means a lot. And we're getting that valuable data, and we're doing something with it. We're making sure that our actions that are reflective of what they've told us. And that's the standard we keep.
I have an interesting take on the cash part. We did a study asking our members if they would prefer credit line increases or credit statements, straight cash. And over 90% of people chose credit line increases. And we were very surprised because we issued these to people and we offered $100 credit line increase or $100 cash. So we ran it a second time with this group of professors, same results. And so when you think about what it is people really value, it was shocking to me too. I didn't expect that either. And when you think of what it is people really value, it's why are they coming in the first place? If you really want to build credit and you understand even some of the components, your credit line plays a big role. If you're just looking for cash, I know we were just talking about this before, like that's a different type of mentality. So you can also learn a lot. We found people do a lot for credit line increases. People do a lot for cash too, but what is it? And I'm sure there's 10 other things that we haven't figured out yet that are somewhat equatable, that are really interesting concepts.
One last quick call for question. Yeah, okay, super. So I am going to use this time to wrap up and really to thank everybody on the panel for to thank this whole room. We have a lot of bankers here, which is very great. People who actually want to be part of the system that works in here. And a lot of support. One thing that struck me on the empathy side is something that my team has really pushed. You probably won't hear us say credit worthy because of that word worthy. And so what our team says, which takes a lot longer and you have to type more, is ability and willingness to repay. And I've heard all of you say ability and willingness to repay. And I'm just, I think that's a very nice, quick thing that we can all focus on. All people are worthy. Some people have ability and willingness to repay. I urge everybody to check out our new papers that will be posted very shortly on where we're going and what the behavioral barriers we're hoping to impact, and then also to check back in to see how each other is doing, to see how each one of these partners is doing. As we're not going to wait till 2029, but hopefully by next year we'll have some good direction on what's working and take it forward. So thank you, everybody, and thank you so much for our keynote. That was great. Yeah, thank you. And Piyush too, but he's not here.